Welcome to the video today, guys, about an under-the-radar company, IHS. I have spent weeks researching and understanding this company for this video today, so stick around to get all of the details. And with that, let's jump right into it. First, we're going to be jumping into a brief overview of IHS as a company and what they actually do. As you guys can see here, they are expert partners in communications infrastructure. They're one of the largest independent owners, operators, and developers of shared communication infrastructure in the world. They own and operate over 40,000 cell towers across 11 markets, including all the countries here below. They were founded in 2001 and IPO'd in 2021. So they've been around for a while, but their IPO is only fairly recent, which makes them a little bit different than most that I actually look into. Generally, I like a longer time frame, but in this case, I'm going to make an exception and you'll see why. Now that you understand a little bit of the company and what they do, let's get into their revenue and actually break down where their revenue is coming from geographically. You can see their revenue sources come from 4 operating segments. Nigeria, they have this labeled as SSA, LATAM, and MENA. You can see each of these places where this all comes from and how their income actually breaks down from each area. About 66% of their revenue comes from Nigeria, which is going to be our main focus here today on a few different areas. And you can see the percentage breakdowns of each other area as well, playing a smaller and smaller role. On SSA, that comprises of Cameroon, Cote d'Ivoire, Rwanda, South Africa, and Zambia. Just to give you an idea that this company plays in emerging markets. These are developing countries that are on the rise. Their populations are growing very quickly, and they're rapidly taking on and integrating the internet and things that we often take for granted here in the US. Anytime that I look at a company, after understanding what they do and how they actually make their money, I also want to understand how their debt situation looks. I am always looking at companies that are down significantly from their peak, so it's important to understand solvency risk. So let's take a look. The current debt situation of IHS, they have a quick ratio of 0.767, which is far above the industry average of American Towers right here, SBAC, and Crown Castle, that are peers in the industry who have a 0.3435 average quick ratio. You can see they're far above that. Their trailing 12 months free cash flow was about $362 million. And you can compare that to their current long-term maturities that are coming up. And we'll touch on their current debt and liabilities as well and kind of see how this matches up along with the cash and things they have on their balance sheet. Another important piece to keep in mind here is they have no meaningful maturities until the end of 2025 and $850 million of available liquidity that they can pull from if they need to. So if you're just breaking it down like this, and after you see their current debt situation that's coming up in the next year, you'll see they're in a pretty strong financial position, especially compared to other peers. Now is what we're going to take a little bit of time to do is actually compare side by side IHS and some of their numbers along with some of the other peers in the industry so you guys can actually get an idea of where they lay, some of their weaknesses, some of their strengths, and to give you guys a good picture. The first thing that we're going to look at is their gross margins. You can see I have 4 companies listed in here along with IHS, CCI, AMT, and SBAC that are all in the cell tower industry. And you can see the different gross margins that they have across the industry here. You can see all of these 3 are in the 60s to 70s range, whereas IHS is in the 44, mid 40s range. You can see at their peak here, they were still at the mid 40s. Which is very different than their peers in the industry. And I want to give a little bit of context as to why. IHS operates primarily in developing countries, as mentioned before. And the reason they give as to why their margins look this way is their towers aren't actually tied into the grid like many of these other companies are. Because they operate in developing countries, many of their towers actually have to have separate power generators attached, which drives down their margins. There's just more cost into having a generator, maintaining that, having fuel, all those kinds of things that go into it. So it drives down their margins. So This is to be expected, but you can see how it compares to the rest of the industry. It is certainly quite a bit lower. Next, to give you guys something to look at here, we are looking at free cash flow margin and how this compares across the board. You can see as soon as IHS IPOs, they are much more competitive with the industry. It's actually SBAC with the highest free cash flow margin of around 44%, whereas all the others are the mid 20s to IHS down to the high teens, but they are much more competitive here and much closer to their competitors, which to me tells me even though their gross margins are lower, their other expenses might be lower than average, which allows them to be quite a bit more competitive on the free cash flow front. But again, you can see they are lower than average, which plays into them having more costs associated running those generators and additional costs in developing markets. Comparing current ratios, you can see the ratios across the industry right here, and IHS sits far above the rest, currently with a current ratio of 0.924, which is far above the others. SBAC sits the second highest at 0.7, and even the others are below that. So their financial position looks much stronger. Next, let's take a look at their debt to EBITDA ratio. You can see that they have a much lower debt to EBITDA ratio than most of these companies here by quite a wide margin, which is really good to see. It means they have a much less leveraged balance sheet compared to these other companies with a debt to EBITDA ratio of around 4, whereas these other companies are above 5 and SBAC even at 7.5, which is very high. So let's take a look at their free cash flow yield, and you can see pretty much all these companies besides IHS are right in line with each other in the low single digits. And remember, free cash flow yield is if a company was to pay out 100% of all the free cash flow they have out as a dividend, what percent yield would that actually be on the current stock price? You can see these other companies are very low, and as soon as we get data on IHS, it is in the high single digits and continues to climb, which is normal for a company that's stock price is declining, but their free cash flow is remaining stable or growing. And you can see at their peak, they had a free cash flow yield of in 41.5. It has since then fallen just a little bit, but is still in the mid 30s, which is much, much higher than all the rest in the industry. Now we're looking at the price to free cash flow. You can see many of these other companies are in the mid 30s, even into the 40s, and have stayed there pretty consistently, dropping down some. And IHS stands far below the rest, trading at a far lower multiple, starting at around 10, trading in that range, and then falling off pretty sharply till now where it is below 3. And you can see why I actually like looking at this company. So far, you've seen that their financial position is pretty strong, although their margin's lower, but that is explainable and normal for the situation that they're in. They're trading a far lower multiple. One of the last pieces that I wanted to share with you guys here was actually the insider ownership and its trend over the past few quarters. And man, I gotta say, I love this. Every single insider that works for the company has increased their position quite substantially since the last filing, with the only one not adding being this right here. Every other person actually increased their position by over 20% from the last quarter, which is awesome to see. They believe in the company. They are sticking behind it. They're putting their money where their mouth is, and it's really cool to see that they believe in the long-term future, and you love to work with a company that looks like this. Last piece here that we're going to look at the opinions of analysts. I don't generally like to, as oftentimes their opinion actually follows the trend. As the stock falls, so does their opinion. But let's just take a look just to give you some other ideas of what people are thinking. You can see their price targets right here. They are significantly above the current trading price. The lowest estimate calls for a 142% gain, the highest almost 600%, which is absolutely insane considering where the price is at now. And this is just to give you guys an idea. Don't buy off this or my recommendation. Do your own work, but I want to give you another perspective. IHS, in their most recent earnings, their stock fell as much as 12% and then settled down about 5% after they announced it. And this UK-based company, they had a revenue decline about 10% year over year. And really, this was driven by a huge impact that we're going to talk a little bit more about of a massive foreign exchange headwind, primarily due to the 78% devaluation of the Nigerian naira starting mid-June 2023. We're going to talk a lot more about this. This is an important piece to this company's story. Let's touch on a couple important pieces that they had in their slideshow presentation from this quarter as well. This is an absolutely amazing graphic that they put out showing how big of a player they are in the industry, only behind a few companies. Obviously, they are pretty far behind these top two, but you can see how widespread they are across several different nations. Another important piece here that's going to be important to go over is how their contracts are actually laid out and how they get paid. You can see 40% of their contracts, they are paid in local currency. About another 40% they are paid in dollars, 14% in euros, and another 8% they're actually paid in just power. So this is going to be important in understanding how they get paid and why their revenue, which you see was 58% from in Nigerian currency, why it was so impacted by the devaluation in this currency and what their split kind of looks like going forward. This is a major story for them going forward, but I'm going to show you guys why I actually think it might not be as big of a headwind as you might think. Getting right to that, one of the biggest reasons why I don't think the devaluation of the Nigerian currency is going to be as big of an issue as it might seem like is how often their contracts with these cell companies are reset. 93% of those contracts are reset quarterly, meaning if this continues in Nigeria and their currency continues to be devalued, every quarter they can essentially reset the prices in those contracts to peg them back to the current value or maybe a little above, so that way they can plan ahead. So while this is still going to be an issue and a headwind, they have significant opportunity to continue to reprice as things come, new revelations come, and things like that. So it puts them in a pretty good position to continue to raise prices as needed, since they don't think anyone is going to be giving up their cell phone or data plan anytime soon. Another important piece that will be helpful in understanding the margins of IHS, you can see how their towers are actually connected to the system. You can see only 7% are hooked up to the grid or solar. 26% are connected to the grid with a backup generator. 24% are generator only, and 42% are hybrid, which is probably a combination of all of these three. You can see why they might not be in the same situation as others that are operating in developed nations that can just connect directly to the grid and not have to have that extra cost associated. Another key graphic that they put up is their current market position in these different countries and what position in the market they currently have. You can see how many countries they are currently the number one provider in. This is absolutely amazing, and you love to be with a company that operates in a monopoly or duopoly situation, and you can see they are the top dog in many countries. Now moving on to the risks that are really associated with the company. Some we've already talked about, some are going to be new, but I want to lay them all out there so you guys can get the full picture. One of the biggest issues that currently has driven the stock price down is MTN is one of their largest customers, providing cell service to their customers. And one of the big issues that they had is they actually did a competitive bid and gave 2,500 of their slots that they would normally have rented out from IHS. They gave them to American Tower, which isn't a huge hit to their portfolio, but does show that they are looking for other opportunities out there and created some fear that they, along with others, might actually move away from IHS to other providers and cell tower owners in the area. They said their preference is always for a bilateral renewal subject to competitive pricing terms. You can see the numbers of how many towers IHS operates and how many are leased by MTN. You can see 13% of MTN's portfolio sits with American Tower Corporation, while 80% sits with IHS. There's mounting fear that they could lose more contracts, like I mentioned before, and they have many contracts and leases set to expire between 2025 and 2029. One of the biggest reasons why I don't think this is actually a huge issue, though, is MTN Group currently owns, I believe this is actually a 26% stake in IHS Towers. This means MTN has a vested interest in having IHS do very well. Pulling their business away from them hurts their equity position in this company. So they are going to really just want to use this as maybe a wake-up call for IHS to say, hey, we got to get things rolling. And you'll see IHS is actually reacting to this, as you might expect, in a good way. Another issue or risk that was called out as of June 28th by Reuters, that some of the shareholders feel that the management has no serious focus and that its performance does not remotely approach the implied financial performance. They just feel that one of the main issues is the company refuses to embrace transparency with investors and just having adequate leadership, people on the board to really help drive things as well as give good communication. And one of the reasons why I actually think, again, this might not be a big issue and you're seeing them take serious action on this. This was a proposal that was sent out on January 16, 2024, just recently. And I'll just read the highlighted sections. Wendell, which is another large shareholder of IHS, and MTN, which together own about 45% of the company, argued, among other things, that all shareholders with at least a 10% stake should have the power to nominate board members. In the agreement reached with Wendell, the ownership threshold for shareholders to nominate directors would be lowered to 10%, exactly what they requested. A new right was also introduced for shareholders owning at least 25% to request a general meeting, and the threshold for removing a director by shareholder vote would be lowered to 50%. In addition, following IHS's 2025 AGM, all directors would be elected on an annual basis instead of waiting for their tenure to end. Issues that many of these companies brought up was really to do with leadership and wanting them to really pay attention to what their shareholders wanted, and these changes are exactly what they were looking for. So their two largest shareholders, Wendell and MTN specifically, which rents out tons of their towers in Nigeria, is now getting what they're looking for. And I think this means they are sticking around for the long term, as well as if you look at how much shares they own, in the past several quarters, they haven't sold anything. They are not running out the door by any means. They are holding because they believe in the future of the company. And that's what I believe and I kind of see there. From here, let's take a look at the financials of this company. As I mentioned before, their current debt situation, their revenue over time, to give you guys some visuals of what this company has actually been doing since their IPO in 2021. Jumping into IHS's financials and their current situation, let's take a look at their revenue over time. You can see the trailing 12 months, they have been growing very well, and it's only been recently in this past little bit that things have looked a little more down. But that was explained earlier by the devaluation of the Nigerian currency. Otherwise, their growth has been up. And if you look at their numbers, which we don't have time to today, you'll see that their organic growth of their revenue is up and up significantly. So this is almost exclusively due to the devaluation of the Naira. Another important piece that we talked about earlier was to look at the current assets versus current liabilities. You can see they have current assets of about $1.1 billion, and they have total current liabilities of $1.2 billion. but they have free cash flow of almost 400 million coming in that's going to supplement anything else they need there. They are sitting in a very good position to be able to just pay that all off and not have to worry about taking on more debt. So I'm not concerned about their current position. When you take this into account with looking at their long-term debt position as well, financially, I like the position of this company, especially when you compare it to other companies in the industry like we looked at earlier. Another interesting metric, if you wanted to take a look, was their return on capital employed. You can see that it is pretty consistently increasing, at least with the data that we have, which again, take this with a grain of salt. It isn't a ton. We haven't seen them operate through many cycles, but you can see it is increasing and doing well even with the headwinds. The very last thing I want to do here with you guys today is actually look at a discounted cash flow model, which is how I like to value companies, and give you guys an idea of where they're actually sitting based on very different numbers, growth figures, intrinsic value versus full valuation. And so let's kind of take a look at what this looks like. First, I wanted to share with you guys what I think price could look like if they have zero growth in their free cash flow, zero growth in their outstanding shares. They have a 15 times price to free cash flow ratio over the next 5 years. What would that price actually look like compared to where they're at now? And you can at least get an idea of right here. But let's take a look down at the numbers. Their fair value to get a 10% rate of return right now is $10. This is honestly insane to me to look and say, I just think they're going to get to their correct price to free cash flow ratio of 15, which is, by the way, much lower than their peers in the industry, but I think reflects a sustainable price to free cash flow for a telecom company, which isn't super high growth, but they are in developing markets. So maybe it could command more than this, but I think this is a fair ratio. But this tells you what potential they actually have. Now let's look at actual growth numbers of what I think they could do. In their industry, and these countries are going to be adopting data usage on cell phone plans much more rapidly than the rest of the industry. And if you look at this company's projections, they are far above what I'm saying here. These are conservative measures, and I think it's very reasonable for a company to increase the cost on their towers by 3 to 4% a year, which can account for that 3 to 4% free cash flow growth. And anything on top of that is them growing and expanding in these countries that they're already in. And they're currently doing that, to give you guys an idea of what I'm looking at. Let's look at maybe a more aggressive price to free cash flow ratio of 20. And let's look at those same numbers, as I think the market often goes through really depressed periods and euphoric periods. So right now it's in a very depressed period. What could things look like if it's in a very euphoric period? And again, this is still actually going to be lower than the price to free cash flow of other peers in the industry, which is honestly crazy to me, because I think this is probably more than I would want to even pay for this company looking at these numbers. Assuming a 4.5% growth rate in free cash flow and a 20 price ratio, this puts us at a $27 stock price. Looking at a 6% growth in free cash flow, $29, and a 9% growth rate puts us at $33. That's an absolutely insane return to look at. Again, to leave you guys with this, do your own work, create your own opinion based on what your needs are. I'm not your financial advisor. I don't know your financial position, but hopefully this was valuable for you guys. To summarize what everything that I see in IHS, There are risks in the Naira currently continuing to devalue, along with issues with current shareholders like MTN, but they are working to resolve those, and they have the ability to quarterly change the price in their contracts, which is going to keep them in a strong position that they already are in, the number one provider in multiple countries. So you guys, again, take this with a grain of salt, do your own work, but hopefully this was valuable.